Welcome to our Module 10, which is long-term liabilities. This is our first video. I'm Jeff Mankin. I help you learn accounting and finance. Now, liabilities are a part of the balance sheet, part of the accounting equation, where assets have to equal liabilities plus equity. So liabilities are just simply debts that the company has, and it's a way for a company to finance its assets is either through liabilities or through equity. Now, current liabilities, remember, are 1 year or less, and long-term liabilities are greater than 1 year. So we're talking about liabilities with 5 or 10 or 15-year life. The best example of a long-term liability are bonds, and bonds are simply financial securities that are created and issued by the borrower and purchased by the lender. So if you own the bond, you're a lender, an investor, and you have the right to receive a stream of payments that are specified in the bond contract. Here's what a bond looks like. The United Aircraft Corporation is borrowing money. It's a $1,000 bond, so it pays $1,000 at the end, and all the terms are given here on this financial certificate. Now, bonds solve a problem, and you need to know what this problem is. If you go to the bank, if a company wants to borrow money, they go to a bank and the bank says, sure, we'll loan you the money. Here's an 8% loan. If the investor goes to the bank is only going to give them a 1% rate of return. So what the bond does is the company can issue the bond, an investor could buy it directly, avoid the bank, and a 6% bond with a yield of 6% will mean that the company has a lower interest rate and the investors have a higher interest rate on their rate of return. It takes an 8% loan and replaces it with a 6% loan. It takes a 1% savings account and replaces it with a 6% bond, where the investors are better off than with the bank. Now, some bond terms we need to know. The face amount is the amount that's printed on the bond certificate and it's paid at the very end. The coupon rate is also printed on the bond. It is only to calculate the interest payments. The term is the length of the bond, also printed on the bond certificate. These next two are not printed on the bond certificate, so it's the yield, what the rate is in the market, or the effective rate. This is basically the market return, or the yield. Every day that number would change. And then the price is just simply the present value of the cash flows. If you know the yield, you can figure out the price. If you know the price, you can figure out the yield. The first three are all given on the bond certificate itself. Now, pay attention, there's two interest rates. It's confusing at first. The coupon rate that's printed on the bond certificate is just really a shorthand, and it's the way to calculate the interest payments. So if we say it's a 6% bond, the bond pays 6% interest payments. It may be in semi-annual payments divided by 2, but that's all that it's used for. Then the yield, or the market rate, is really determined by the market. That changes every day. The coupon rate never changes for this bond because it's printed. The yield and the market rate changes daily. So let's talk about a real simple bond. A real simple bond would be a bond that does not pay interest payments. So it's a $100,000 face amount, $100,000 bond. It has a 0 coupon rate, or a 0 coupon bond means it does not pay interest, no interest payments. So let's see how it works. Along the way, there's no interest payments, and at the very end, this bond pays $100,000. So this is a very simple calculation. If you want a yield of 6%, what happens? The bond doesn't pay 6%, but the bond is discounted and sold to yield 6%. So we need to use time value of money. So your financial calculator or spreadsheet like Excel. So the periods per year would be 1. The number of periods would be 5 because it's 5 years. We now know the interest, the yield is 6%. We know that we're solving for present value. Our payment is 0 because there's no payments in this this bond because it's a 0 coupon bond. The future value is $100,000 face value. So if we solve, we get 74,726 basically. I gave you the pennies just so you can kind of verify. So what that means is if you spend 74,726 and you receive 100,000 at the end, you received a 6% rate of return. So simple, right? All right, let's look at a basic bond. Our basic bond, this is going to be the same bond. We're going to do it 3 different times with different yields so we can calculate the present value 3 different times. So if we have a $100,000 bond that pays 6% semi-annual interest payments for 5 years, let's think about the payment schedule. All that does is set up a payment schedule. The $100,000 is paid at the end. The 6% times $100,000 is going to be $6,000 every year, divided by 2 since it's semi-annual. So we're going to receive, if you buy the bond, a $3,000 payment, 1, 2, 3, 4, all the way through 10. And don't forget, at the very end, you'll receive $100,000. There it is. So you're going to receive 10 payments of $3,000 each. And then finally, at the end of 5 years, at the end of 10 payments, you'll receive a $100,000 payment. So what's all this worth? Well, we need to figure out, well, what's our yield? If our yield is 5%, then what's this worth? What is the present value? So the periods per year are 2. The number of periods is 10. The payment is $3,000, and the future value is $100,000. We know all that by looking at the bond itself, the certificate. We now gave you, what if the yield is 5%? If the yield's 5%, then we can calculate it with time value of money, and that's 104,376. So at 5%, you're going to pay 104. If you pay 104, you're going to receive a 5% rate of return. So if you paid $104,000, you'd receive $3,000 along the way. You'd receive $100,000 at the very end. That is a 5% rate of return. All right, this is the same bond, just the second example. So $100,000, 6% bond for 5 years. Obviously, the payments would be just the same. You'd receive $100,000 at the end and $3,000 along the way. Well, what's the value of this bond? What's the price of the bond, or the present value, if the yield is 7.5%? So if you discount at 7.5%, you have the same periods per year, number of periods, payment, and future value. All this is the same. If you put in 7.5%, then you calculate it to be $93,840. So if you wanted a 7.5% rate of return, you'd have to pay $93,840. Or really, the yield in the market is 7.5%. So therefore, this bond would be discounted down to $93,840. If you paid $93,840, you received a 7.5% rate of return because you received all these payments just like before. All right, the third iteration of this bond problem, same bond, the same schedule of payments, but now we say, what is the price of the bond if the yield is 6%? Now, this 6% should be easy because this bond is a 6% bond. If we use 6% as the yield, then 6% equals the 6% coupon rate, then this bond sells for exactly $100,000. So if you paid $100,000 for this bond, you'd receive a 6% rate of return, and that's what the bond's built at. That's easy to calculate. So let's think about the bond. Just looking at a bond, here's what we have. So on this bond, for example, we have a $1,000 face amount shown right there. We have a 5 3/8 interest payments shown here We have a 25-year term. It's in the paragraph down below. So if you wanted to set this up, here's what we know. Periods per year is 2. It's a 25-year bond, so the number of periods would be 50. The payment would be $1,000 times 0.05375. 3/8 is 0.375. So 5 3/8 interest would be 0.05375 divided by 2. So $26.88. The face value is $1,000. So if you bought this bond, you would be receiving 50 payments of $26.88, one payment at the end of $1,000. Now, by looking at the bond itself, we do not know the yield, the market rate, or the price, which is present value. So here's what we know. If we know the yield, we know the price. If we know the price, we can figure out the yield. So just a time value of money problem. Now, let's think about how interest rates affect the bond prices. We've seen this, but let me be clear. If the interest rates rise, it went from 6 to 7.5. What happened to the price of the bond? It went down to 93,840. If interest rates rise, the price of the bond falls. Well, what if interest rates go down? What if it goes from 6 to 5% like we saw in our example? Then the price would rise up to 104,376. All right, that's it for our first video. See you in the next video.